Hi everybody, it's Paul Brown here from Wealth 21. We are now well into the new calendar year of 2023. This video just covers a market review for last year, 2022, and also has a bit of a look at the early stages of 2023. So firstly and importantly, any information in this video is just general information only. It doesn't take into account your specific circumstances. So before you consider any changes to your own investments, please seek advice from us or from an authorized financial advisor. Okay, so let's have a look firstly at the index returns over effectively the calendar year of 2022. So you can see that the yellow highlighter there shows that there was a lot of losses in most sectors. So importantly though, the defensive sectors of Australian bonds and global bonds, that was very unusual to see losses of that magnitude. That happened because of inflation emerging early in 2022 and then central banks around the world having to start to aggressively increase interest rates. But we also saw losses in listed property, both in Australia and globally, down 20.1% and 24.2% respectively. Global shares was also down 12.5% in Australian dollar terms. Australian shares actually fared a little better, just down 1.1% for the calendar year. Looking at the green highlighted areas though, over 10 years you see you get what we expect, which is the growth assets of property and shares produce the better long-term returns over the 10-year period. So moving on now, I've done this chart which shows the index returns for various different investment strategies. Of course, for our clients, what we do is we go through a risk profiling process and to understand people's tolerance for risk. But there's three strategies here: conservative, which is 70% defensive, 30% growth; balanced, which is 50-50; and growth, which is 30% defensive and 70% growth. So just looking at the index returns for those different strategies, you can see that it didn't really matter which strategy you used in the calendar year of 2022, where there was going to be losses because there was losses in most sectors of the market. So conservative down 6.4%, 7.6% for balance, and 8.1% for growth. Over the longer term though, again over 10 years, you see you get what you would expect with conservative investments producing 4.9% return per annum, 6.6% for balance per annum, and 8.1% per annum for growth, which is well above inflation over that time period, which is 2.3% per annum over that period. Actually, even cash over the last 10 years hasn't actually beat inflation, because inflation over the last 12 months has risen, was showing at 7.3% per annum over the past 12 months. So moving on now, just to have a quick look at January 2023. I mean, we've had more positive, green shoots is an economic term for more positive news in the markets. And we do have to also take into account that the markets are looking ahead in terms of the economy. Sometimes the economy can get worse, but the markets will actually improve. So in the month of January, we had most sectors showing gains. Australian shares up 6.2%, Australian listed property up 8.1%, global shares up 3.1%, Australian bonds up 2.8%, and global bonds up 2.1%. So all of the sectors that had significant losses during the calendar year of 2022 were showing some gains in the month of January. We've got Reserve Bank meets on Tuesday of next week, so expecting another rate rise, and we'll probably see at least 2, maybe more rate rises from the RBA during 2023. It kind of depends on what happens with inflation. Final slide, I just wanted to have a look at residential property, which is in the news a fair bit lately, and the relationship, I guess, that residential property has with the Reserve Bank interest rates. So this chart just shows that the RBA started raising rates in May of 2022, and it shows that in a lot of capital cities, the residential property market measured by CoreLogic have fallen in value. Sydney down 13.9% since the first rate rise. Brisbane down 9.9%. Melbourne is down 9.4%. Adelaide and Perth have been more resilient. So that just shows the relationship between interest rate rises and mortgage rates, of course, and house prices. Of course, this is a very short-term chart. If you look at longer-term charts, you would realise that residential property went up a lot over the past few years. So this is a correction in price because, and not so much of an issue for long-term investors. But if you're a short-term investor in property and actually followed the guidance of the RBA, who said that interest rates were going to be low till 2024, borrowed a lot of money and bought, then there's some short-term losses to deal with there. So there we go, a bit of an update. If there's any questions you have, please feel free to give us a call or send us an email. Thank you very much.